Friends, thank you for being here today. What if I told you that the next financial crash, the one everyone is bracing for, won't look anything like 2008? And what if I told you that by preparing for that last crisis, the world is making itself perfectly vulnerable to the real one that is already underway? The collective financial memory of our time is scarred by one singular event, the financial crisis of 2008. This event has become the benchmark for disaster, the lens through which all future economic turmoil is viewed. As a result, the public, guided by a media that feeds on familiar narratives, is bracing for the wrong catastrophe. They are anticipating a deflationary crash, a painful but understandable echo of the past. They are looking for falling stock tickers, for sale signs languishing on lawns, and the tightening grip of a credit crisis. This expectation, however, is a dangerous miscalculation. The crisis that is now approaching is not a cyclical correction. It is a structural unraveling of the entire global financial system. What looms is not a repeat of 2008, nor is it a successor to the dot-com bubble of the year 2000. Those events were market-specific collapses. They were devastating, to be sure, but they were ultimately contained fires within the larger structure. The foundation of the building, the money itself, remained intact. The problem we face today is not a crack in a single market, whether it be housing or technology stocks. The problem is the foundation beneath all markets, the very definition of value. The trust placed in our currency is what is eroding. This is not a cyclical storm. It is a changing of the climate itself. The reason this distinction is critical and why the coming collapse will be so much worse than 2008 lies in the fundamental nature of the crisis. The 2008 event was a deflationary crash. It was a credit bubble. When it burst asset prices, the nominal sticker price of stocks, bonds, and homes collapsed. In that environment, cash was king. The value of the dollar itself was not in question. In fact, its purchasing power increased as assets became cheaper. The crash, as painful as it was, acted as a reset button. It was a violent transfer of wealth, but it presented an opportunity for new buyers, for those who held cash, to enter the market at generational lows. The system, though severely damaged, was ultimately rebooted. The coming crash is the antithesis of this. It is an inflationary crash. It is not a crisis of credit, but a crisis of currency, and at its core, a sovereign debt crisis. When this bubble bursts, the nominal prices of assets will not fall. On the contrary, they will appear to explode upward. The illusion of wealth will be everywhere as stock portfolios and home valuations reach dizzying new highs. But this rise will be a mirage. It will be the frantic symptom of wealth fleeing a dying currency. In this type of collapse, the reset button is broken. There is no buying the dip when the dip is the very money in your bank account. The consequence of this is profoundly more devastating. Assets like housing will not become cheaper. They will become permanently unaffordable for the average citizen, purchased only by the already wealthy as a desperate store of value. Savings, the reward for decades of work and prudence, will be inflated into nothingness. The middle class, the bedrock of social stability, will be hollowed out not by unemployment, but by the silent, relentless theft of purchasing power. There is no recovery from this, no chance to get back in later. This is why this time is worse. It is not a reset, it is a finality. Now, to really understand the mechanics of this inflationary unraveling, we first have to identify the real bubble. It's not hidden in the complex derivatives that felled the economy in 2008. It is, in fact, hidden in plain sight, masquerading as the very definition of safety. The greatest bubble in human history is in government bonds, specifically US Treasuries, and in the fiat currency that backs them, the US dollar. For decades, an illusion of safety has been meticulously constructed around these assets. The US Treasury bond has been the risk-free asset, the foundation upon which all other financial valuations are. The dollar has been the world's reserve currency, the default medium of global trade. But this status was built on a promise of fiscal prudence that has long since been abandoned. For generations, governments, particularly the United States government, have solved every economic crisis, every cyclical downturn, and every political promise with the same two tools: printing more money and issuing more debt. Each crisis, from the dot-com bust to the 2008 collapse to the 2020 pandemic response, was met with an exponentially larger wave of monetary creation. This policy felt like a miracle. It seemed to solve every problem without immediate consequence. But the consequences were not avoided. They were merely deferred. The world now sits precariously atop an unprecedented, unimaginable pile of government debt. Trillions upon trillions of dollars created from nothing. Promises stacked on promises, all backed by the full faith and credit of governments that are themselves functionally insolvent. We have borrowed from the future for so long that the future is now here and the bill is due. This brings us to the mechanism of the collapse, the sovereign debt crisis. The US government is no longer borrowing to invest, to build, or to grow. It is now borrowing trillions of dollars every single year simply to maintain its basic operations, to pay the interest on its existing debt, and to keep the lights on. The mathematics of this are unforgiving. The debt is growing faster than the economy that is supposed to support it. A breaking point is not a possibility, it is an inevitability. The most terrifying evidence of this is that the free market for this debt has vanished. In a healthy system, private investors, foreign governments, and pension funds would willingly buy US debt. Today, the only significant buyers left for this mountain of new debt are the central banks themselves, like the Federal Reserve and domestic institutions that are effectively forced to buy it by financial regulations. The government is issuing debt and the central bank is printing money to buy that debt. This is not a market. It is a closed loop. It is an artificial and brittle system, a serpent eating its own tail. When this system finally cracks, when there are not enough forced buyers, or when the world loses its last shred of confidence, the government will be left with only one tool. It will not be able to pay its debts through taxation or growth. It will be forced to pay by creating new money. The Federal Reserve will print currency not to stimulate the economy, but to monetize the government's obligations. This is the precise moment an inflation problem transforms into a hyperinflationary crisis. It is the moment the currency itself fails. This is the engine of the reverse market crash. As this process unfolds, it is not a collapse of prices, but a collapse of purchasing power. The boom we see in certain assets is the illusion. The reality is that capital is fleeing the sinking ship of fiat currency. When you see asset prices rising, you must ask yourself, is the asset becoming more valuable, or is the money I used to buy it becoming more worthless? In this crisis, the answer is unequivocally the latter. Investors are not seeking growth. They are seeking scarcity. They are not chasing returns. They are fleeing debasement. This is the central misunderstood dynamic of our time. And the symptoms of this currency sickness are not hidden in obscure financial reports. They are visible to anyone who knows where to look. The warning signs are flashing bright red, signaling a massive systemic flight of capital away from fiat currency and into anything that is perceived as scarce or real. The most prominent signal is the extreme concentration in the US stock market. A healthy, growing economy is characterized by a broad market rally where hundreds of companies across all sectors are thriving. What we have today is the exact opposite. The entire market is being held aloft by a tiny handful of Mag 7 technology stocks companies like Apple, Nvidia, and Microsoft. As of recently, these few companies account for over one-third of the entire market capitalization of the S&P 500. A traditional analyst might see this as a sign of the durable strength of the tech sector. A currency debasement analyst sees it for what it is, a desperate pseudo-safe haven bid. This is not a sign of a healthy broad economy. It is a sign that investors no longer trust cash and they no longer trust the broad market. They are pouring their money into these few mega corporations, which they view as digital fortresses, entities so large, so profitable, and so dominant that they seem safer than the currency itself. The record high prices of these stocks are not a bubble in the traditional sense. They are a symptom of the currency bubble. The other side of this same coin is the simultaneous and explosive surge in hard and scarce assets. When viewed through a traditional lens, the current market makes no sense. Why would gold, an ancient monetary metal, be hitting all-time highs at the same time as Bitcoin, a decentralized digital asset? Why are tangible collectibles, fine art, and even non-fungible tokens, NFTs, commanding such high prices? A traditional investor sees these as separate speculative bubbles driven by irrational mania. But when you understand that the real bubble is the currency, this behavior is not only rational, it is predictable. Gold, Bitcoin, art, and even certain digital collectibles all share one fundamental crucial property: scarcity. You cannot print more gold. The supply of Bitcoin is algorithmically fixed. You cannot print another Mona Lisa. In a world that is drowning in an infinite ocean of infinitely printable paper money, scarcity becomes the only true store of value. This is not speculation. This is a safe haven bid. It is the sound of millions of people consciously or unconsciously running for the lifeboats. They are grabbing anything tangible, anything real, anything that cannot be devalued by a central bank's keyboard. The irrationality is not in buying these assets. The irrationality is in holding cash and believing it is safe. Now, you might be wondering where this distortion is most obvious. Well, nowhere is it more pronounced or more painful for the average person than in the housing market. The dream of home ownership has been twisted into a financial nightmare, and the market itself is completely, perhaps irreparably broken. This did not happen by accident. It is the direct result of decades of government distortion that has now collided with the new reality of an inflationary crisis. The root of this distortion is threefold. First, for decades, the government has artificially inflated the market through subsidies. By guaranteeing mortgages through entities like Fannie Mae and Freddie Mac, the government removed all risk from the lenders. This created a classic moral hazard. leading to progressively looser lending standards, dangerously low down payments, and the extension of massive credit to borrowers who were not truly creditworthy. This flood of bad credit did not make housing more affordable. It simply pushed prices up to levels that could only be afforded with these same reckless loans. Second, the tax code was engineered to push people into home ownership, whether it was the right financial decision for them or not. By offering significant tax deductions for mortgage interest while offering none for rent, the government actively subsidized buying and punished renting. This is not a free market. It is a massive program of social engineering that distorted the decisions of millions of families, pushing them into massive levels of debt to chase an artificial tax incentive. Third, and most acutely, came the COVID era intervention. When the Federal Reserve slashed interest rates to zero, it unleashed a refinancing boom that acted as the final fatal blow to the market. Millions of existing homeowners locked in once in a lifetime fixed mortgage rates in the 2 to 3% range. These mortgages are now arguably their single greatest financial asset. This has led to the current paradox, a completely frozen market. We have seen one of the most rapid increases in mortgage rates in history, with rates soaring from under 3% to at times over 8. In any normal functioning market, this would have caused a catastrophic crash in home prices. But prices have not crashed. In many areas, they continue to rise. The reason is that the market is starved of supply. Existing homeowners are trapped by their golden handcuffs. They are never selling. They cannot afford to. To sell their home, even at a high price, would mean giving up their 2 to 3% mortgage. They would then have to buy a new home at today's equally high prices and finance it with an 8% loan. Their monthly payment would instantly double, triple, or even quadruple. It is a financial impossibility. They are staying put. This has created a massive permanent inventory shortage. These homes are effectively off the market for a generation. With no supply and with new construction stifled by soaring material and labor costs, a product of the same inflation, prices remain stubbornly high. This brings us to the future of housing prices. Those waiting for a 2008 style crash for prices to fall by half will be waiting forever. We will not see a major nominal crash in housing. The inventory crisis, combined with the systemic inflation that is flooding the economy, will keep the sticker price of homes painfully high. The crash in housing is happening, but it is a crash in real terms. The price of a home measured in ounces of the housing market paradox. How golden handcuffs are making banks insolvent. Gold is falling. The price of a home relative to the cost of energy or a basket of groceries is falling. Affordability has utterly collapsed. The combination of high prices, high interest rates, and the skyrocketing non-negotiable costs of insurance, property taxes, and maintenance has locked out an entire generation of young and middle-class buyers. The housing market is no longer a ladder for wealth creation. It is a fortress wall, and the average person is on the wrong side of it. But this paralyzed housing market is not just a social crisis for buyers. It represents a mortal threat to the banking system that underpins the entire economy. The golden handcuffs locking homeowners in place are the very same leaden shackles pulling the banks underwater. This is a core reason why the current situation is infinitely more precarious than 2008. In that crisis, the problem was defaults. Banks lost money when borrowers failed to pay. Today, the problem is far more insidious. The banks are losing money on the good loans, the ones that are being paid perfectly on time. Consider a bank whose balance sheet is filled with those 2 to 3% mortgages issued during the pandemic. That mortgage is a bank's asset, but now the bank's own cost of capital, the rate it must pay to get money, which is tied to the Federal Reserve's 5% plus funds rate, is dramatically higher than the return on its assets. Every single performing loan at 3% is now a losing proposition for the bank, bleeding it dry month after month. This nightmare scenario is not limited to mortgages. The same Federal Reserve policy forced banks to load up on risk-free U.S. Treasury bonds that were also paying near zero interest. As the Fed rapidly hiked rates, the market value of these bonds collapsed. The banks are now sitting on hundreds of billions, if not trillions of dollars in unrealized losses on these safe assets. They are by any sane definition functionally insolvent. The only thing concealing this reality is an accounting gimmick. Regulators allow banks to pretend these assets are worth their full face value under the assumption that they will hold to maturity perhaps decades from now. But this is a fiction that can only survive in a climate of calm. This is not a theoretical problem. This is precisely what destroyed Silicon Valley Bank and other regional banks. They were not undone by risky loans. They were undone by safe government bonds. When depositors asked for their money back, the bank was forced to sell those bonds at a catastrophic loss, making their insolvency real and immediate. The entire too big to fail system is now a too big to market system. It is a fragile house of cards, stable only so long as no one pulls a card out. The moment a widespread loss of confidence begins and depositors rush for the exits, the hold to maturity fiction will evaporate. Banks will be forced to sell their underwater assets. The losses will be realized, and the true insolvency of the entire financial system will be exposed for all to see. So this brings us to the end game. The intricate, over-leveraged, and artificial system is now running on fumes. The central banks, once the masters of the universe, are now caught in a trap of their own, making a trap from which there is no escape. This is the central bank trap. They are damned if they do and damned if they don't. If they raise interest rates high enough to genuinely fight the inflation they have created, they will bankrupt their own governments. The US government, for example, simply cannot afford to service its massive debt at high interest rates. A significant rate hike would trigger a default and a collapse of the bond market. Therefore, they cannot truly raise rates. Conversely, if they lower rates again to stimulate the economy or bail out the bond market, they will be throwing gasoline on an already raging inflationary fire. This would signal to the entire world that they have given up all pretense of defending the currency and have resorted to undisguised printing. This is the path to hyperinflation. Rock and hard place, insolvency, or hyperinflation. There is no third option. There is no soft landing. The system that was once the source of global stability has now become the primary source of global instability. When the public finally awakens to this reality, the final and most important pillar of the financial system will crumble. Trust. Money is not paper, it is trust. Bonds are not the end game, the central bank trap, and the great transition of wealth assets. They are promises. When the trust in the promises dies, the paper becomes worthless. And when trust in money dies, no government policy, no central bank intervention, and no political speech can revive it. The system will break. This moment will not be a financial event. It will be a transition of wealth. It will be the most significant and brutal redistribution of property in modern history. The winners and losers of this transition will be clearly defined. The losers will be those who followed the old rules. They will be the ones who played it safe. They will be the prudent savers who held their wealth in cash. They will be the retirees on fixed incomes and pensions who believe the promises made to them. They will be the conservative investors who hid in government bonds believing they were risk free. The middle class, the savers, and the elderly will watch as a lifetime of work is erased by a system they were told to trust. Their safety was in fact the single greatest risk. The winners will be those who understood that the game had changed. They will be the ones who saw the currency crisis for what it was and acted accordingly. They will be the people who moved their wealth out of paper promises and into scarce real assets that cannot be printed by a government. The outline of history is clear. They will be the holders of gold and silver. They will be the holders of decentralized non-sovereign assets like Bitcoin. They will be the owners of productive land and real estate if financed correctly. They will be the owners of real cash flowing businesses that can adjust their prices to the new inflationary reality. The coming collapse is not just a financial reset, it is a fundamental redefinition of wealth. It is the end of an era built on illusion and the beginning of one that will be forced to reckon with reality. It is a painful, brutal, and chaotic transition away from a system of paper promises and infinite debt and toward a new system that must be built on tangible, provable, and scarce value.